on your channel.
Yeah, absolutely, absolutely. I didn't think of that, actually. That's absolutely true. Okay, so 30 minutes is going to be, we're going to do it. We might run a little over, but you said you wanted to talk about spreads and straddles.
Yes.
So those are advanced option strategies. And the first thing we're going to be doing is identifying it, because if you can't identify it, not only is that a test question, even if it wasn't, I just told you it is, but even if you can't identify it, you don't know what to do next. So
Right.
you got to kind of say, be able to look at it and say, okay, is this a spread or is this a straddle? You know, you're going to know that you have two option strategies going on. So a spread is going to be long and short, the same type of contract. And a straddle is going to be long two different types or short two different types. So to help us organize our discussion, I came up with a little slide here for us. Boom. Can you see my screen?
Yes.
Okay, so we're going to talk about spreads and straddles. Now, spreads are a bigger deal on your exam than our straddles. And straddles are pretty straightforward. So we'll go through the spreads first, and then we'll go through the straddles. Now, I call it don't hate the 8. Don't hate the 8. There's 8 things you're held accountable for in your exam.
Okay.
So any one of these things we're going to discuss could be a test question. Now, I always think you should have some kind of a process. You know, it's a buffet, take what you like, leave what you don't. But if you have a process, it'll be easier for you. And if you keep doing the process, at some point, it'll become hopefully second nature. You know, what happens with options, particularly advanced option strategies, multiple option strategies, is the lights go on and they go out again, and they come on again and they go out again. So you just got to keep working through that. Now, it sounds like, I'm assuming that since you asked for this as our topic of discussion today, that perhaps, maybe not, but let's just see, that you are feeling comfortable with the basic option strategies. Are you comfortable with selling an Apple June 140 call at 11?
Selling, yes. It gets tricky when it's, you know, different things involved.
Yeah, this would just not be smart. So let's just talk about this one. So I think you should always, underneath the leg you're looking at, not test question, but that's what we call that, a leg. Say, what are you looking at? You're looking at an obligation to sell the stock at the strike price. Right now, Apple's 141. Who cares? You know, on the test, we don't care where Apple's at when we do this trade. We care where Apple's at when we close this trade.
Mhm.
So, you know, in test phraseology, they say your customer sells or goes short or writes or does an opening sale of one Apple June 140 call at 11. Now, if that's all we did, we would really be what I call a dumb bear. You know, there are smart bears and there are dumb bears. And the reason that would be a dumb bear is because if all you do is that, all you do is a naked call, 140 would be the strike. And if it's 140 or lower, if Apple's 140 or lower, the contract expires and you get to keep the money. And, you know, that would be wonderful. But if you're wrong, so basically what we're saying is if Apple's 140 or low at expiration, you do a naked call, the contract would have no intrinsic value, and you'd be able to go neener, 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 and you get to keep the money. But there is a problem with agreeing to sell stock you don't own. Right? You're agreeing to sell 100 shares of Apple there and you don't own it. And how far up might the market price of Apple go? Unlimited, right?
To the moon, yes.
To the moon. I like that. To the moon. All right, so this is really just foolish. You know, your break even would be 151, right? Anywhere between 140 and 151, you'd make money. Past 151, you start to lose some money. And so what I might suggest to you, the conversation is not testable. What I might suggest to you is let's take some of our money and let's offset our obligation to sell the Apple with a choice to buy. Because then we would no longer have unlimited risk. You know, options are all about floors and ceilings. So we're going to put in a ceiling here. We're going to have a choice to buy the stock at the strike price. And now we're no longer a dumb bear, because now we're saying, okay, well, we want to be able to, if we're wrong, close this out. So one thing we need to understand about options, particularly spreads, is what we're going to be discussing. By the way, we haven't done any test question yet, except that this is a spread. All the action takes place between those two prices. As I said, there's a floor and there's a ceiling. So now what we're saying is we want to play between 140 and 155, and then we don't want to play no more.
Mm.
So that's what we're doing. We're doing a spread. So the spread, by the way, is the difference in the premiums. We're getting ready to start doing some other stuff here in just a sec. But what I'm saying is I want to play between 140 and 155, and then I don't want to play no more. I want to go home.
Hey, Dean, is that always the case? The strike prices are the floors
Yep,
and the ceilings?
That's exactly
Okay.
right. So, you know, the one test taking trick when we start rolling here is if I ask you like gain or loss, you can't come up with any numbers that don't add up to 15. Because that's all the action that's there, right? So all the
Okay.
action takes place between the strikes. Okay, so now we're ready to move on to the second of our 8 test questions. And this next thing, to number 2 of the 8, is really important, because if we get this right, we rock and roll. You know, there's a lot of things that are pretty complicated in a spread, but one thing that isn't complicated is if you can memorize sin or do. So we get credit, we can go credit, expire, narrow. I'm going to show you what that means in just a sec. You'll be right every time. If we get debit, we can go debit, exercise, widen. We'll be right every time. I'm going to illustrate that to you in just a sec, but that's really important because we can really rock and roll. Now, the other thing that's important about it is we should know, Erica, that when we sell options, our best gain is that nobody victimizes us. We agree to be a potential victim. Nobody victimizes us, and we walk with the money, neener, neener, neener. And we should know that if we pay a money, that's going to be our worst case. So that's going to be important in a minute here as well. Okay, so the next thing we got to be able to do is determine whether this is a credit spread, more money in than out, or a debit spread, more money debit spread, more money out than in. So how are we going to do that?
Do we look for the driver?
Well, you could do the driver. I'm going to do the driver later. I didn't ask you what's the dominant leg. We need to net the premiums.
Oh.
But you're right. The one with the greater premium is going to be the dominant leg.
Okay.
Right? Because remember, we started with a naked call, which was not smart. But what we're going to do now is we're going to net the premium. So is that 11? Is that 11 money out or money in that 11?
In.
Right on. So that's an opening sale. Now, I suggest you do this on a point per share basis, but you know, you can do it any way you want as long as you get the right answer. But you know, I just don't like having a bunch of zeros floating around. And so, you know, then when I'm all done, I say, okay, well, you know, what's going on there? All right. So now is that 3? Is that 3 money out or money in?
Out.
Right on. So this is a really key piece of the analysis. And so we're going to do that. Now you could use pluses and minuses. You could use debit or credit, whatever you'd like. I like to use dollars out versus dollars in. And so now we're going to net that premium. And let me just get myself a little room here. We're going to net the premium, and we're going to find out this is 8 points more in than out. So let's put that there. Let's get our 8. And we're going to call that 8 our net credit. Net means the difference. So we have a net credit here of 8. That's just from netting the premiums. We'll put that there. Let's put underneath that is a net credit so we can remember what it is. It's more money in than money out. Okay, so now once we've established this as a net credit, we can really rock and roll. Now, don't think about it till you get the menu done. So in other words, you know, credit has 6 letters, expire has 6 letters, narrow has 6 letters. If you don't understand options, and I'm an option guru, and I say, what do you want to do? And you say expire narrow, I'm not going to know whether you know what that means or not. It doesn't matter. You'll be right 100% of the time. But after you get it done, then you can think about it and say, okay, well, if this was the position in my account and my broker called me and said, these contracts expired because Apple's 140 or lower, would you be happy or would you be sad? I'd be happy. You get to keep the money, right? Anytime you collect money, the best case is you get to keep the money. So we definitely want the contracts to expire. Now, pay attention, Eric. I think you're kind of a jerk of a customer. If when these contracts expire, you say, Dean, had I done the naked call, I would have made 11. And I wasted 3 points on that 155 call. And so I only made 8. I said, well, that's true, Erica, but making 8 and losing 7, we're not there yet, is smarter than making 11 and potentially losing everything. So yeah, we didn't need this ceiling, but oh well, so we have a net credit here. Okay, let's put that over here as well. So let's put, some people are visual people. If you're a visual person, I wouldn't be recommending you graph anything on the test, but in terms of what's going on here, we have a net credit here of 8. And let's just put a line here. Boom. And I'm going to put a little thing here. That's, we're not doing higher math here, but that just means the absolute value. So, whether it's a plus or minus doesn't mean it's 8 points in terms of that. I'll explain what I mean by that. And there's no graphic at all on the test, but that's going to be our net credit. And we want to have that somewhere. By the way, no matter what option strategy we're talking about, if you collect money, that's going to be your max gain. So whether it's a straddle or spread or anything you collect money, that's your best case scenario, right? Okay, so we only have done three of our 8 things. We have identified this as a spread. We are long and short the same type of contract. Now, do you use a matrix perhaps?
No.
Okay, well, I was just going to say, if you use a matrix, right, here's my matrix. And, when I'm using a matrix, a spread, as we said, here's what we're doing. Boom, boom. We're long a call and we're short a call. So I go to show you a put spread. I'm not, because we only have 30 minutes, but a put spread would look like this. Long a put and short a put, right? So long and short, the same type of contract. Okay, so we're on our fourth thing. So we've identified this as a spread. We've determined that it's a credit spread because we got more money in than out. Now, this is the hardest part to get, and you don't need to get it because credit, expire, narrow goes together all the time. Now, what we're referring to there is the difference in the premiums. So the difference was 8, and I needed to become smaller. If I could close this out for 6, I'd make 2. If it expires worthless, the difference would be 0. I'd make 8. Hardest part to get, don't need to get it. I have entire lectures, Erica, videos where you can watch what I mean by this thing about widening and narrowing. You don't need to get it because once you tell me it's a credit spread, you tell me expire, you tell me narrow, and you'll be right how often.
Every single time.
Every time. Now, if it's debit, then it's do. I think of it like Mountain Dew or Nike, just do it. Or when you're like me and you're wide, you need to exercise. Debit exercise always goes together, right? I joke in some cultures, my wideness is a sign of wealth and prosperity. Unfortunately, not here. So, now you should know that the maximum gain, the maximum loss. So we're working here on a credit spread. And we said one of the tricks in a spread is to know that the gain and the loss always equals the difference in the strikes. It would be bad form for you as a test taker to give me any answer about gain and loss in a spread that doesn't equal the difference in the strikes, because that's the whole point of floor and the ceiling, right? So if we look here, the gain and the loss that we're looking at here has got to add up to 15. So if, I ask you gain and loss on a spread on your test, you can eliminate anything that doesn't add up to 15. So whatever that gain and loss is, it equals the difference in the strikes. Because remember, that's the whole point of the strategy, by the way, is we're playing between the strikes. And then we don't want to play no more. So the gain and the loss always equals the strikes, difference in the strikes. Now, of those two numbers that add up to 15, we already have one of those numbers, right? So 8 plus something, let's just put that there. We said that's going to be our max gain. Anytime we collect money, the best case is we agree to be a potential victim, nobody victimizes us, and we keep the money. Now, Erica, if you decide to memorize things, I'm just warning you, if that's the road you choose to go down, the amount of things you're going to have to memorize are going to continue to compound. You're going to have lots of things to memorize. So I'm telling you that whatever these two numbers are, they add up to 15. These two numbers, right? Because we got a 155 call here and 40. So you can either memorize.
Okay.
You can either memorize that the maximum loss of the credit spread is the difference in the strikes minus the net credit. Ugh. I just think that's a mental mess personally. But if you don't want to memorize that, then what you can do is say, okay, well, 8 plus something equals 15. And what would that something be?
7.
Yeah, it's always got to be two numbers that add up. So I'm going to put that there, and then let's just real quick, we'll label that as our max loss. And then I'll illustrate. Don't think about to get the menu done, though. As I said, we're not going to be thinking about things till we get the menu done, because if you get this menu done, you've got my guarantee that whatever they want to know, you've got the right answer to it. And then, you know, after you get that done, you can think about it. So difference in strikes. Now here is our visual representation of that. I'll show that to you in a minute. So there's our difference in our strikes is 15. So we just said that 8 plus something equals 15. So our maximum loss, it's always going to be the two numbers that add up to that, right? So we can make 8 and we lose 7. Now, once you get down, you can think about it, say, okay, if I buy the apple at 155, which I have a choice to do, and I deliver at 140, I'm going to lose 15 points. But of the 15 points, I already have in my account 8. So I lose 7. Now, don't do the thinking until you get the menu done. But we do want to make sure that we have in the video, you know, for you and other watchers, how to do that in terms of memory work. So if you want to memorize, it would be the difference in the strikes less the net credit. I just think that's a mental mess. In our example, those two numbers are 15, and we have one of those numbers already. And the number we already have is 8. And so we know that this number is 7. I just think it's easier. Now, break even, the break even is somewhere between. So another test taking trick. The break even has got to be somewhere between 140 and 155, because all the action takes place between the strikes. So you could go to your answer set right now and eliminate any offer to you that is below 140 or above 155. The break even's got to be somewhere between those two numbers. Now, we said that's the whole point, right? Is the floor and the ceiling. We want to play between 140 and 155. Now, we have a great memory aid device when working with calls. Call up, put down, right? So the way we're going to get our break even in our spread, our call spread, our memory aid device is CAL. And that stands for call add to the lower. That stands for call add to the lower. So this is a call spread. And so the way we're going to get our break even is we're going to add the net premium to the lower strike. right? So our lower strike is 140. And we're going to add our net premium. Doesn't matter what's a debit or credit. What is our net premium?
8.
Right on. So we're going to take our 8, our net premium, and we're going to add it to 140. And we get our break even of 148. Now, again, stay menu driven. Don't think about that till you get the menu done. Once you get the menu done, then you can think about things, but don't be thinking about things until you get the menu done. What I mean by that is once you get the menu done, then you can say, okay, well, let me think about it. If I buy the apple at 148 and I deliver at 140, I'd lose 8 points. I got 8 points. I break even.
Okay.
Nobody does things to break even, right? In terms of being a happy camper or not being a happy camper. Right. So here's my happiness is in between these right here. I'm going to be a happy guy. Right. 148 or lower. And here I'm going to be an unhappy guy. Right. So that's where we're playing. We're playing between these two numbers, right? Those are why we're doing this. What we're doing is not testable. The menu is all right. So we're making pretty good progress. We have 8 things we get tested. Don't hate the 8. We've identified this as a spread. We determined it's a credit spread. Therefore, we're going to expire and the difference in the premiums to narrow. We've done our max gain, our max loss. We've done our break even. So the last thing we got to be able to do is determine bullish or bearish. Now, it sounds like you have a pretty good handle on this earlier because you had told me that you're going to go for the dominant leg. And that is actually what you're going to do, right? To figure out whether you're a bull or a bear here. You don't have to do it in the order we're doing it, but you know, that's my process. So the dominant leg is a short call. And so if it's a short call, are you bullish or bearish? Is the spread bullish or bearish?
Bearish.
Right on. The larger premium dominates the position. Right. So that's what you said, and you are correct. By the way, it's always going to be the lower strike call that's dominant because lower strike calls always have greater premiums. Now, you could have done that right out of the gate if you want. I'm just providing you a menu. So, you know, it sounded like that's what you wanted to do right out of the gate, and that's fine. You could have just done that. You said, Dean, I'm going to go for the dominant leg. And you certainly could do that. But at the end of the day, these are the 8 things. And if you are doing these 8 things, you've got the answer. Now, there's another trick you could use too to determine bullish or bearish. And that trick is just a trick you can amaze your friends at a cocktail party. Well, you know, you came from the Bible, or maybe not. But, you know, Jesus's first miracle was turning the water into wine. My father is a missionary, and he tells me that it was non-alcoholic wine. I think, I don't know about that. You know, anyways, if you want to use this trick, it's just a trick, but it works all the time. You could say, because, let me get a smaller font, you are long the lower strike. In any spread, doesn't matter, call, put, whatever. If you're long the lower strike, you are a bull. And if you're not, you're a bear. So we're not long the lower strike here. And so that means we are bearish. It's just a trick, but it's long the lower strike. Whoop, looks like I, boom. Oh, come on, don't take my whole thing away. So if you're long the lower strike, it's a bullish spread. Doesn't matter if it's a debit, credit, call, put. Now we do want to fill in the rest of the menu for somebody who has a put spread, and the mnemonic there we're going to use is push. And that stands for put subtract from the higher. So if it's a put spread, we're going to subtract from the higher strike to get the break even. And remember, the trick is that it's always going to be the break even somewhere in between there. All right, so let's just go back now and let's review these 8 things you're held accountable for on your exam as it relates to a spread. And so we said the first thing that you are held accountable for on your series 7 is identifying the position. And we said, even if that wasn't a test question, I told you it was. I said, even if that wasn't a test question, I told you it was, you're stuck. Because otherwise you're just going to be staring at it going, I don't know, B, you know. You know, at some point that might be a strategy, but you know, until while you're still working, you know, you want to try and figure it out. So as I said, when you're doing a spread, what you're trying to do is either you're changing the risk or reward. Conversation is not testable. But again, here, I know that selling a 140 call at 11 naked is just stupid. That's just really not smart, right? Because that has unlimited loss potential. And so near here, I have a floor, but I don't have a ceiling. Options are all about floors and ceilings. Or another way to think about it is spreads are all about floors and ceilings. All the action takes place between the strikes. So I say, you know what I'm going to do is I'm going to get some of my money here and go buy myself a higher strike call just in case. I'm going to put in a ceiling. I have a floor at 140, but I'm going to put in a ceiling at 155. And now I'm no longer a dumb bear. I don't want to be a dumb bear. The conversation is not testable, but don't be a dumb bear, right?
Right.
No, smart bear. So now I'm going to be a smart bear, right? So you have to tell me that's a spread. Test question number one, that's a spread. Test question number two, is it debit or credit? And if we get this, we can rock and roll. A credit spread is when we have more money in than out. If we had more money out than in, it would be a debit spread. All right, once we get that, we can rock and roll because credit, expire, narrow goes together all the time. So now we rock and roll. We say we want it to expire. We can keep the 8 points. Whenever you collect money, I'm going to show you a straddle here in just a little bit. I know you're excited. And whether it's a short straddle or short spread, whenever you collect money, the best case is you really be a potential victim and nobody victimizes you. Neener, neener, neener. So the best case, you're going to make that 8 points. Now, if the difference in the premiums gets smaller, and again, I'll put in the video description for those who will be watching this, a whole video on this concept of widen or narrow. But you don't need to get it because narrow has 6 letters, credit has 6 letters, expire has 6 letters, credit, expire, narrow, you'll be right every time. How many times will you be right?
Every time.
If it's debit exercise widen, you'll be right how often?
Every time.
Every time. So, don't get too much in the weeds on that. All right. So we said one of our tricks is to know that there's a lot about 140 and 155. And we said that the gain and loss always equals the difference in the strikes. There's 15 points to be made or lost. We collected 8. So our max gain is 8. We said you can either memorize, if you memorize, it's just a pain, right? Because you got to memorize the maximum loss, that credit spread is the difference in the strikes less than net credit. Or if it's a debit, you got to memorize the max gain and debit spread is the difference in the strikes less than that debit. I just think that's a mental mess. I think it's easier to say there's 15 points to be made or lost. I collected 8, so I can only lose 7. I just think that's easier, but however you get there, you need to get there, right? Our next thing we got to be able to do is break even. As a test taker, we should know the break even has got to lie somewhere between the strikes. That alone will get you a 50-50, right? Because you could chop your answer set and by process of elimination say, I'm not taking anything that's 140 or lower as an offer, as a break even, and I'm not taking anything that's 155 or higher. That'll leave you with 2 choices. Right now, that sounds silly, but 2 choices is still a good place to be at because then you have a 50-50, right? We're either going to use call or push. We're either going to call, add to the lower. We're going to take the lower strike. If it's a call spread, add the net premium. In this case, 140 plus 8, and we get our break even of 148. If it's a put spread, we're going to use push, put, subtract from the higher. And then we said our last thing we got to be able to do is bullish or bearish. The larger premium dominates the position, which in this case is a short call. And so that's the dominant leg. And so this is a bearish spread. All credit call spreads are bearish. By the way, credit call spreads are bearish, but that's better than being a naked call, right? So that's what's going on. Again, the strategy is not testable. Okay, so the other thing you wanted to review in your coaching call is straddles. And so let's do that. Let me clean up our slide. And as I said, straddles, I think, are a little more straightforward. So I believe in being menu driven. So we said our menu for spreads had 8 items on it. Our menu for spreads, Erica, only has 4 things we got to be able to do. We got to be able to identify a straddle, even if that wasn't a test question. I just told you it is. But even if it wasn't, I just told you it is. If you can't identify it, you don't know what to do. You're just going to be staring at it. So the first thing you got to do as a test taker is say, what am I looking at? Am I looking at a spread? Am I looking at a covered call? Am I looking at a straddle? What am I looking at? I had a young lady I was helping, and I said, the first thing you got to get, and I told you, you're one of my favorite students of late because you work hard. It's a function of working hard. I don't know when we told people that learning is easy. You can take a magic pill or something. If I had that, I'd be rich. But anyways, in her case, I said, first thing you got to do is figure out what you're being asked. And then what I thought was funny, she told me, Dean, I've got that now. I can figure out what I'm being asked. I still can't figure out what the answers being offered to me are, but at least I know what I'm being asked. I said, okay, well, that's the next part. You got to get to where you can shop the answer set and know what those are about, right? So pretty straightforward here. We got to be able to identify it. We got to be able to calculate break-evens. This is the only strategy in which we have two break-evens. It's the only one. Every other strategy only has one break-even. Here we got two. We're going to have what's called our upside break-even. And we're going to have our downside break-even. Number three, we got to determine where is the straddle profitable. Do we want the market price in between the two break-evens, or do we want it outside the two break-evens? And I have a great memory aid device for that. And that memory aid device is called Silo. Silo. That's a good memory aid device to remind us that if it's a short straddle I'm showing you, we want it inside. And if it's a long straddle, we want it outside. So that is a great memory aid device for straddles. And then our last thing we got to be able to do is determine when do we use a straddle? When do we use a straddle? So we're expecting a trading range, whatever the case may be. So in preparation for your coaching call, you told me you wanted to do spreads and straddles, and I thought, well, 30 minutes, that'll be a challenge, but hey, it's your coaching call. You're long the coaching call, so we'll do whatever you want to do. And so I pulled, again, an Apple slide for us to kind of look at in terms of straddle. So let's look at this slide here, and I'm going to show you two. So here's the market price of Apple. That's the blue line. And the price of Apple can be anywhere from 0 to what? Infinity.
To the moon.
Right? So here's the thing, Erica. I'm not really sure what's going to happen with Apple. I told you Apple right now is 141, and they got a lot of challenges. They got a lot of challenges in their business, and I wouldn't. I don't know how Tim Cook's going to respond. He's the CEO, and they've got factories in China that are just now coming online. Here's what I don't think, Erica. I don't think Apple is going to stay in the 140 area. I think it's going to move. I think it's either going to go way up or it's going to go way down. Now, if I thought it was going to go way up, I would buy a call. And if I thought it was going to go way down, I would buy a put. So what I'm going to do is I'm going to do both. Because the idea here is I don't know which direction it's going to do. I'm going to buy an Apple September 140, call it 6. And I'm going to buy an Apple September 140 put at 7. I got two of these things. Okay, so we've identified it as a straddle. A straddle is when you're long two different type of contracts or short two different type of contracts. So the next thing we got to do is calculate the break evens. Now, if I really wanted to teach you options, I'd make you buy one. Once you were out of pocket, you'd figure this out pretty quickly. Right? You got to get back your money. And so is that 6 money out or money in?
Out.
That's right. So what we're going to do is we go back to this previous slide, right? We're going to take the strike price plus total premiums, strike price minus total premiums. Remember this, call up, put down. So our combined premiums, so buy, or sell, we combine them. It's like Domino's, pizza. So we got 13 points here out. So I'm going to need either 13 points up or 13 points down to cover my out-of-pocket cost. So I'm not being facetious here. I am terrible at arithmetic. So I'm not going to trust myself to take 140 minus 13. I know people are going to be laughing watching the video, but hey, you don't want to miss things because you can't do math.
I'm right there with you, Dean.
I've over the years took the 7. I had to take the 7 a couple of times. And, they used to give scores, and I took it one time and I thought the ones I missed, if I knew what they were, I would petition and say, I don't think I really missed them. And then I was teaching a class and I missed a break even because I couldn't do arithmetic. And I go, that would have been embarrassing. I bet the handful of questions I missed were probably just not being able to subtract 13 from 140. Anyway, so 140 is our strike. So I need either 13 points up or 13 points down to cover my out-of-pocket costs. So now I have my two break evens. I got an upside break even. I got a downside break even. By the way, in terms of it being a happy camper, you know, I'm going to be happy. You know, I want to be happy. Try to change colors here. Come on, there we go. I'm going to want Apple to be either above this or below that. I'm not going to be happy if Apple's in between here. Right. So test question number one, can you identify a straddle? Test question number two, can you calculate the break evens? Test question number three, where is it profitable? We have a good mnemonic for that. Silo, short inside, long outside. This is a long straddle. So I want Apple to be above 153 or below 127. Fourth test question, when do I use it? I use it when I'm expecting volatility, but direction is uncertain. Right? I either think Apple's going up or Apple's going what?
Down.
Yeah, I don't think it's going to stay still. You know, I had one where we had a new CEO who was coming to take over, and I thought he's either going to fix their problems or he's not. And so I bought a call and I bought a put. There was a public company that had a court case, and I thought they're either going to win or they're going to lose. If they win, I think the stock's going up, and if they lose, I think the stock is going down. To be honest, Eric, I don't care, just as long as the stock moves. I'm buying volatility. Now, we also have short straddles. So every strategy has its opposite. So as we said, we want to be able to identify straddle. We said it's long two different type of contracts, or it's short two different type of contracts. So we have long straddles, we have short straddles. And we have straddles with different strike prices. As we said, the first thing you got to be able to do is identify the strategy. Because if you don't identify it correctly, God knows you're going to think, oh, I got to do 8 things. No, this is a straddle. We only got to do 4 things. We have to identify it. We have to calculate the break evens. It's going to be the same break evens, long or short. Call up, put down. So we're going to have our upside break even. And we're going to have our downside break even. It's the same break evens. And then remember, this is the difference. Where is it profitable? And short inside. Now we're doing this one. We want Apple to be between 153 and 127. There is a problem with a short straddle. So we've identified the short straddle. We have determined the calculated break-evens. We determined where it's profitable, short inside, long outside. Here we expect a trading range. We expect Apple to stay 127, 153. I'm a winner. Ideally, Apple's 140. Woohoo! Both contracts expire, neener, neener, neener. Can you see a potential problem? Can you see a potential problem with a short straddle? If I'm wrong.
Oh, double loss.
That's right. It has unlimited loss potential. Because on the downside, it can go to 0, but on that upside, so a short straddle has unlimited loss potential. So it's pretty seductive. I say, hey, Erica, do you think Apple's going to stay between 127 and 153? If so, there's a way to profit. You know, that sounds pretty seductive. Apple right now is 141. But if we're wrong and it goes outside of those break evens, ooh, you got to make a call there. So, you know, if I come into your office and say, Erica, I want to lose so much money that you can't tell me in advance how much. You say, well, that'll do the trick. You know, naked calls, short straddles. All right. So we have done what you wanted to do in your coaching call. We went over spreads and straddles. We said the biggest takeaway is have a process, have a menu. And I'll link to some, you know, more in-depth lectures on this stuff where you can dig a little deeper on each of these items, whether it be this idea of intrinsic value, whatever the case means. We said for spreads, you got to be able to do 3 things, or excuse me, 8 things. You have to be able to identify it. You've got to be able to determine debit or credit. I'll do it the other way this time. Debit or credit, exercise or expire, widen or narrow, max gain, max loss, break even, bullish or bearish. You do those 8 things, whatever they want to know, you've got the answer. Don't hate the 8. You want to be process driven. So don't just be willy-nilly jumping into spreads. We said that first thing is identify it. And then we said score 4 more. Score 4 more. On a straddle, we said there's 4 things you got to be able to do. Can you identify it as a straddle? Again, Erica, I said, even if that's not a test question,
It is.
I told you it is. But even if it wasn't, it is. If you can't identify it, you're going to be stuck. So
Mhm.
that's the first thing on both those menus. You got to be able to say, what am I looking at?
Mhm.
Now, some point in the future, you can worry about straddles with different strike prices called combinations. I wouldn't worry about that at this point, right? But, baby steps. Score 4 more. Can you identify? 2, can you calculate the break evens? Strike price plus total premiums, strike price minus total premiums. You're going to get an upside break even and a downside break even. Number 3, where is the straddle profitable? We have a great mnemonic device for that memory aid, silo. Silo, short inside, long outside. If it's shorter straddle, you want it in between the 2 numbers. If it's long, you want it outside the 2 numbers. And our 4th test question is, when do you use it? You're either buying volatility or you're selling volatility. When you buy a straddle, you're expecting volatility up or down. You're not sure. That's the whole point, right? If you were sure it was going up, you'd buy a call.
Mhm.
If you were sure it was going down, you buy a put. You're not sure. So you say, well, hey, I'll just buy both. Right. So, or you expect it's going to stay within the trading range. You're selling the volatility. You're saying, yeah, I don't think it's going to move that much. I'll take that money. So those are what's going on there. Any other questions before we end our coaching call?
No, Dean, that was great. Thank you.
Hey, listen, remind me next Tuesday. We'll let you enter the drawing again, but let's make sure that if I forget, let's tell Marcel that he can't enter next week.
Oh.
I don't want him people thinking it's not fixed. I can't control that draw, but I want to make sure I think I'm going to add that to our little disclosure. Something like, if you won last week, you can't win again just because we're trying to spread it around. Right. So
I agree.
yeah, I think that's a fair rule, I think, don't you?
That is very fair.
Okay, so let's just remind me, if you join us next Tuesday, to disclose that if you have won the coaching call, then you can't win the coaching call. You have to take a timeout. I don't know what we'll call it, a break. You can re-enter. I think the following week would be fair, right? So Marcel, if he wins, he takes a break and then he can get back into the draw.
That's fair.
Okay, I'll talk to you later. And
Okay.
this will be, if you want to rewatch, it'll be up on the YouTube channel here in a little bit.
Okay. Thanks,
Okay.
Dean.
You bet. Bye-bye.
Bye.